question about dividend reinvestment plans. I'm not quite sure how they work. I have a stock, Marathon Oil, MRO, paying about a 3% dividend. I was wondering if I should reinvest that in a plan, or should I just take the proceeds, invest it on my own?
Dividend reinvestment plans, or DRPs as they're better known, are offered by many companies as a way for shareholders to automatically convert dividends into additional shares of the company's stock. Although the underlying premise of DRPs is basically the same, the requirements for joining a DRP, like the initial investment that's needed, sign-up fees, ongoing costs, etc., vary from company to company. For example, in the case of the company you mentioned, Marathon Oil, the DRP requires a $10 one-time enrollment fee, although Marathon picks up the brokerage costs of the shares you acquire through its program, and sometimes even offers a discount of up to 3% on the shares you buy through the plan. You can get full details by going to the Shareholder Services section of Marathon's site, where you'll find contact info for the plan's administrator, as well as a copy of the plan's prospectus. Now, the upside to DRPs and direct stock purchase plans, called DSPs, is that they may be able to help you acquire shares on a regular basis at a lower cost than you would by going through a brokerage firm. That's especially true if the dividends you're collecting aren't large enough to buy many shares. For example, if you own 100 shares of a stock selling for $30 that's paying quarterly dividends of, say, 25 cents a share, it would be impractical to invest through your broker. Your $25 quarterly dividend payment wouldn't be enough to acquire even a single share. Not to mention that even a rock-bottom $10 brokerage fee would mean you'd be giving up 40% of your investment to commissions. With a DRP, by contrast, you can probably buy fractional shares at no or low cost. The downside is that it may require a bit more work to build a well-balanced portfolio using DRPs and DSPs. Typically, you need at least 20 and probably more like 40 to 50 different stocks to have a fully diversified portfolio. Creating a portfolio that size through DRPs and DSPs may be cumbersome and certainly requires more work than, say, investing in a low-cost stock mutual fund that will automatically reinvest not only your dividends but any type of gains at no charge. You can get more information about DRPs and DSPs by going to sites such as First Share. To see whether a particular company offers the DRP option, check out the Investor Relations section of its website. If nothing else, if you enroll in a DRP and stick with it, that steady drip, drip, drip of reinvested dividends could add up to a big bucket of shares over time.